we are seeing a downshift or a slide in a growth estimate coming and positionings are in overcrowded zone, that's where the risk appetite has started taking to a bit of an hit and people have started worrying about recession directly rather than thinking the first scenario, soft landing, which JPMorgan economists are calling.
You just came back from Indonesia and you had a summit there. In terms of what portfolio allocators are looking at, we've been hearing a lot about the uncertainty on the international markets, on the export-oriented markets especially, and diversifying and staying or invested in India and Indonesia with their strong structural drivers makes sense. Does that make sense to you?
No, definitely it makes great sense to me because right now positioning still sits with a very tech-heavy oriented or an export-oriented positioning. But when we look at the market dynamics where dollar is depreciating, oil prices are already off 10 to 15%, and most probably you are going to see not only easing by Fed, but you are going to see easing start happening from emerging market too. We just saw last month Philippines started the easing. So taking that three factors into account, dollar depreciation, lower oil prices and rate cut, that sound a good scenario for domestic demand. And when domestic demand comes into play, economies like India, ASEAN, and even some part of China are going to be the big beneficiaries as a domestic heavens.
Is the gloss coming off the India story, though? And how prepared are investors to pay up for the growth, given where multiples are?
A global growth slowdown is a reality, which means not just the US, across the world, we will see that global economies take a breather. And why? Because we have seen excess tightening in the monetary policy, not just by Fed, but even by RBI and other central banks part of the world too. And hence, it is now taking a hit amount of growth. Last quarter, we saw GDP print coming down almost a 15-month low. Earnings have also slowed down, but it will be unfair to extrapolate fully. As I've said, dynamics like rate cut easing may start bringing growth back either end of this year or early next year, and that can act as a cushion overall. So right now it's being pragmatic to be cautiously optimistic rather than keeping a same tone what investor had start of this year. Hence, we have also changed our allocation. We have reduced some amount of a cyclicality from the India allocation and gone a tactical defensive stance with overweight on consumer staples and healthcare sector with a kind of a barbell approach, still preferring the long-term theme like capex, industrials, healthcare, which still benefit.